My opinion is, yeah, the U.S. can revalue gold, but what they'd have to do in that instance is they would have to nationalize the gold mines in the United States, because that's where the gold is. It's in the ground, has not been mined yet.
Today, we explore Bill Holter's bold idea. Could the U.S. revalue gold by nationalizing its own gold mines? Stay tuned to uncover Holter's unique perspective on gold, the risks of market defaults, doubts about U.S. gold reserves, and the potential consequences of printing more money. Not only explore this unconventional notion, but also delve into Bill Holter's insights on the risks of default in the futures market for gold and silver, along with his skepticism about the validity of the U.S. gold reserves. He believes that there's gold waiting to be mined right here in the United States. Watch the full video until the end to understand what Bill Holter wants to convey to you. Let's begin.
Yeah, it does, because the foundation is debt. The foundation really to the world's financial system are U.S. treasuries. And I mean, you had a 10-year treasury that got, that's risen almost 4 percentage points at this point. And when interest rates go up, the value of treasuries, whether it's short-term, intermediate, or long-term, they all go down. Short-term obviously doesn't go down as much, but the 10-year and the 30-year drop dramatically as interest rates rise. So what that does is it shrinks the collateral. And what's holding the entire system up has been collateral. And I think you need to go back and you need to look. Interest rates peaked in 1982. And rates started coming down into 1986. Then the Fed started tightening. They tightened pretty aggressively in 1987, and we had the 87 stock market crash. They were tightening again in early 90s, and we had the sovereign debt crisis, the debt and currency crisis. Then in 1997, they were tightening again. We had the long-term capital management crisis, then the dot-com bubble, and then, of course, the 2008 great financial crisis. But understand that each time that the Fed tightened, they never went to or above where rates were in the previous cycle until this time. Mm-hmm. Well, the stock market's not pricing higher rates in. Real estate, you mentioned commercial real estate. I mean, look at the hotels that have turned over and have turned over for less than 50% on 2015's dollar. Less than 50%. I mean, there's hotels that have sold recently less than 50% of what the price was back in 2006. So it's already affecting the volume in commercial real estate and prices in commercial real estate, certainly affecting the volume in housing. So, the interest rates, and just look at what happened back in March and April. We had 4 big banks blow up, and the assets of those 4 banks, a lot of people don't know this, but the assets of those 4 banks combined was greater than everything that collapsed, than the banks that collapsed back in 2007, 2008, 2009. So it's already a big deal, and it was becoming a big deal. And you could see that in the reverse repo market last fall. A year ago, the reverse repo market started to really struggle, and the Fed was having to put $100 billion a night into the reverse repo market because there was a liquidity crisis beginning. And then, of course, in the springtime, you had the banks. Those 4 banks blow up. So it's already affecting the real economy. So the best thing to do is to have your stocks issued to you in certificate form. And I know I'm going to get a ton of questions on how to do it. You call your broker, you tell them you want the certificate. If they tell you it's going to cost you $500 per certificate, then what you do is you tell the broker to move the stock to the transfer agent. Once the stock is moved to the transfer agent, then contact your transfer agent. They'll charge you $10 or $20, something like that. to have the certificate itself issued. And once you have the stocks in hand, obviously don't lose them, because if you do, it's going to cost you 3 or 4% in the form of a surety bond fee to get those stocks replaced. But physical ownership of the stock is basically proof that you're an owner in the company. And it doesn't matter if your broker or clearinghouse or whatever goes out of business, you have a physical, if you want to call it a receipt. That's what your certificate is proof of ownership. Well, you'd have to say that silver is more, if you want to use the word speculative, than gold, simply because it's more volatile. It goes up faster and it goes down faster. Silver is the metal of the common man, and gold is the metal of kings, if you will. The reason you own gold is to get your serious wealth from here to the next system, whatever it's going to look like, intact, and you'd still have capital. Silver, you would use silver along the way for barter, but with the current ratio at 80-1, in other words, it takes 80 ounces of silver to buy 1 ounce of gold, it comes out of the ground at 10-1. So God's ratio is 10-1, man's ratio is 80-1. One of the two is wrong, and I think figure out which one's incorrect. Mm-hmm. So what I'm telling you is, based on the ratio, silver should way outperform gold going into the next system. The only problem with silver is if you're talking about large amounts of money, you've got a storage problem. Whereas, I mean, you literally could put 500 ounces of gold into a computer bag, weigh, I don't know, 35, 40 pounds or whatever it is. And you're walking around with $1 million, in current dollars. Mm-hmm. So, there's a portability problem with silver. There's a storage problem with silver, but it is very undervalued to gold. It should outperform gold drastically. It doesn't really matter who goes first. It matters who has what. But I mean, even 3-4 years ago, I could have shown you on the back of a napkin that China has over 25,000 metric tons. And that's in comparison to the supposedly 8,300 tons that the U.S. claims to have. The U.S. has not audited their gold since, I think, 1956. And you've got to ask, well, why have they not audited? Their excuse is it's too expensive to perform an audit, which is complete horse shit. I mean, they spend, billions of dollars on trying to figure out the sexes of toads or something stupid like that. So for them to not want to spend 20 million or 40 million or whatever it costs to do the audit, that's a bogus reason. And the real reason is the 8,300 tons of gold is not there. It's invalid because first off, the numbers, even if the U.S. did have 8,300 tons, and I did this calculation, I think 3 years ago, if the U.S. revalued the 8,300 tons versus, I think when I did the math, it was a 23 trillion or 25 trillion in debt that the U.S. had, you had to come up with $125,000 an ounce. So now at this number of 32 trillion, you got to be pushing $200,000 an ounce. So it would be a ridiculously high number, but a valid number. My opinion is, the U.S. can revalue gold, but what they'd have to do in that instance is they would have to nationalize the gold mines in the United States, because that's where the gold is. It's in the ground, has not been mined yet.
Thank you for joining us on this intriguing journey through Bill Holter's insights. If you found this video informative and thought-provoking, please like, share, and subscribe for more content like this. Your support helps us continue to explore unconventional ideas and perspectives in the world of finance. Stay tuned for more eye-opening discussions. Until next time.